January producer price index data, released this morning, came in above expectations, sending precious metals markets sharply higher. Headline PPI registered at 2.9%, exceeding the projected figure of 2.6%. Core PPI climbed to 3.6%, well above the forecast of 3.0%. Gold and silver prices moved sharply upward immediately following the release of those figures. Western spot silver is currently trading at $92, a level that represents the takeout of a significant prior high established on Wednesday of the previous week. That Wednesday high at $92 has now been surpassed, marking a notable development in the week's price action. Following that prior Wednesday session, prices had pulled back sharply to $85 before recovering. The recovery was preceded by a technical pattern on the hourly chart involving the 150 exponential moving average confluence and a swing failure pattern that cleared the Tuesday 9 o'clock New York session low before reversing to the upside. With 92 now taken out, the next identified tape reading objective is set at $94. Silver has also closed the month of February in positive territory, marking 10 consecutive monthly green closes, a streak not recorded since the historic silver run leading into 1980, when prices climbed from $6 to $50 per ounce over an 18-month period. These developments are unfolding against a backdrop of widening Eastern premiums, significant vault drainage in both Shanghai and on the Comex, escalating geopolitical tensions, and structural shifts in how Indian regulators are directing mutual funds to price physical precious metals holdings. One of the most significant data points currently drawing attention in the silver market is the pronounced price divergence between Eastern and Western markets. Shanghai spot silver is presently trading at $104, with Shanghai futures at $107, while Western spot silver sits at $92. That represents a premium of $12, up from $9 the previous day, being paid by physical buyers in Shanghai over Western paper prices. China precious metals data from February 27th confirmed that Shanghai premiums held firm even as Western spot prices climbed, meaning the gap between Eastern physical demand and Western paper pricing widened simultaneously during the rally, rather than narrowing as might be expected in a temporary arbitrage situation. Turning to what occurred during the trading halt that took place on Wednesday, significant contract activity was recorded during that 90-minute window. 159 million ounces of March silver contracts changed hands during that period, a time during which retail participants were completely locked out of the exchange. Of those contracts, over half did not roll forward into the next delivery month as would be typical behavior for long position holders intending to maintain exposure. Instead, those contract holders accepted cash settlements and exited their positions entirely. Total open interest in silver futures is currently collapsing rather than rotating, with participants closing out positions rather than carrying them forward into subsequent delivery months. While these paper market developments were unfolding, physical demand activity was simultaneously being reported in other parts of the world. At Bullion Star in Singapore, queues of buyers were reported wrapping around the building, with individuals waiting in rain to purchase silver and gold. This behavior was noted as occurring during a period of price correction rather than abating because of it, which observers described as characteristic of physical metal buyers as distinct from paper market participants. On the vault side, the data from both Eastern and Western depositories showed notable outflows during this same period. In Shanghai, 11.5% of silver was drained from vaults in a single day, with nearly 40,000 kilograms leaving Shanghai Futures Exchange vaults on February 27th alone. Comex data recorded 1.3 million ounces drained during the trading halt, with 218,000 ounces withdrawn from Brinks, 624,000 ounces from HSBC, and additional withdrawals recorded from JP Morgan and MTB. Total Comex registered silver stands at approximately 86 million ounces, with open interest at over 120,000 contracts. The resulting coverage ratio of 0.60 means that registered silver currently covers 60% of 1 month's delivery obligations. Significant regulatory developments out of India are adding another dimension to the current precious metals landscape. A total of $385 billion in equity fund capital has been approved for precious metals allocation, with positions of up to 35% now permitted. This represents institutional capital receiving regulatory authorization to rotate into hard assets. Additionally, starting April 1st, Indian regulators have directed mutual funds to value physical precious metals holdings using domestic exchange prices rather than London Bullion Market Association benchmarks. This represents a formal decoupling from Western price-setting mechanisms, with 33 days remaining until that directive takes effect. Against this backdrop, historical patterns in silver market behavior are being referenced for context. In 1966, the S&P peaked, and silver subsequently exploded in 1980. In 2007, the S&P again peaked, followed by a significant silver run in 2011. The pattern observed across these cycles is that when equity markets stall for extended periods without making new highs, capital has historically rotated into alternative assets. Current retail positioning in silver is described as minimal relative to levels seen during the 1970s. ETF holdings contracted over the past year, even as silver prices climbed, indicating that the price appreciation occurred without significant retail participation. For comparative context, when retail began accumulating aggressively between 1979 and 1980, silver moved from single-digit prices to $50, because market structure was unable to absorb that level of demand. Currently, if 250 million ounces were sold through ETFs, the resulting surplus would push prices sharply lower, illustrating how thin current market structure remains when flow direction reverses. On the geopolitical front, the United States State Department authorized the departure of non-emergency personnel and family members from Israel. Bomb shelters were reported to be opening across Israel. The State Department statement advised persons to consider leaving Israel while commercial flights remain available. Separately, as the United States and Iran situation escalated, $650 billion was added to the precious metals market capitalization within a 3-hour period. Gold rose 1.33%, adding $470 billion to its market capitalization, while silver rose 3.82%, adding $190 billion. These price movements are being characterized as monetary hedges against potential oil supply disruptions, shipping route closures, and currency depreciation in the context of military escalation. The source material also presents a series of risk factors representing the bearish case for silver. The Chicago Mercantile Exchange demonstrated during Wednesday's session that it is capable of intervening when delivery pressure builds, and such intervention could continue. The Shanghai premium could compress if Chinese industrial demand softens on a seasonal basis. Geopolitical situations have historically de-escalated more frequently than they have resulted in full escalation. Retail positioning could shift from accumulation to liquidation. A flow of 250 million ounces through ETFs would immediately and severely stress market structure. Vault restocking could also proceed at a faster pace than current withdrawal rates suggest. These factors are presented as real possibilities that could slow or reverse current momentum. Bringing together the full scope of developments covered in this report, January Producer Price Index data came in above expectations, with headline PPI at 2.9% against a forecast of 2.6%, and core PPI at 3.6% against a forecast of 3.0%. Gold and silver responded immediately to that data, with Western spot silver climbing to $92 and taking out the prior Wednesday high that had been identified as a key level. Silver has now closed the month of February in positive territory, marking 10 consecutive monthly green closes. This is identified as a historically significant streak, with the last comparable period of sustained monthly momentum occurring during the run into 1980, when silver advanced from $6 to $50 per ounce over 18 months. Gold has simultaneously posted its 7th straight monthly record close, its longest such streak since 1973. On the structural side, the Shanghai premium over Western spot silver currently stands at $12, with Shanghai spot at $104 and Shanghai futures at $107 against Western spot at $92. That premium widened from $9 to $12 in a single day and continued holding through the rally rather than compressing. Shanghai vault drainage of 11.5% occurred in a single day on February 27th, with nearly 40,000 kilograms leaving Shanghai Futures Exchange vaults. Simultaneously, Comex recorded 1.3 million ounces drained during the Wednesday trading halt, with withdrawals from Brinks, HSBC, JP Morgan, and MTB. Total Comex registered silver stands at approximately 86 million ounces, with a coverage ratio of 0.60 against current delivery obligations. During the 90-minute Wednesday trading halt, 159 million ounces of March silver contracts changed hands, while retail participants were locked out. Over half of those contracts did not roll forward. Holders accepted cash settlements and exited entirely. Total open interest is collapsing rather than rotating, reflecting full exits rather than position transfers to subsequent delivery months. On the institutional side, $385 billion in Indian equity fund capital has received regulatory approval for precious metals allocation of up to 35%. Starting April 1st, Indian mutual funds have been directed to value physical holdings using domestic exchange prices rather than LBMA benchmarks, representing a formal regulatory decoupling from Western pricing mechanisms, with 33 days remaining until implementation. Geopolitically, The United States State Department authorized departure of non-emergency personnel and family members from Israel, with bomb shelters reported opening across the country, and the public advised to consider leaving while commercial flights remain available. $650 billion was added to precious metals market capitalization within 3 hours, as the United States and Iran situation escalated, with gold adding $470 billion and silver adding $190 billion during that period. Retail positioning in silver currently remains minimal relative to historical bull market levels, with ETF holdings having contracted over the past year, even as prices climbed. The next identified tape reading objective for silver is $94. All data points referenced throughout this report are drawn directly from the source material and are recommended for independent verification through primary data sources, including Comex vault reports, Shanghai exchange data, and publicly available regulatory filings. That concludes this broadcast report on current precious metals market developments.